Tick, tock, tick, tock. That's the sound of time slipping away, never to return. And while each passing minute brings you closer to retirement, anxiety creeps in. Will you have enough? Have you invested wisely? Because the clock never stops ticking. The average American retires with less than $200,000 saved up, which translates to a meager $1,000 monthly allowance. Clearly, that's not enough to fund the carefree golden years you've dreamed of. So what can you do? How do you flip the script and set yourself up for lifelong wealth and financial freedom? Robert Kiyosaki has the answers. He has identified 6 assets that are proven wealth builders. Assets that can work for you to generate passive income streams. We're talking the kind of money that lets you upgrade from business class flights to a Gulfstream jet. The game is rigged against the middle class, but Robert will show you how to gain the upper hand and win. Welcome to MoneyWise Investor, your trusted source for financial information. In today's video, we'll be exploring the insights of Robert Kiyosaki, a financial educator who has guided countless individuals to financial freedom through intelligent asset acquisition. But before we get there, let's address a few prevailing myths around building wealth. Contrary to popular belief, prosperity isn't reserved for a privileged few who won the genetic lottery, nor is it about timing perfect market moves or finding some complex money loophole. As Robert Kiyosaki revealed through his teachings, the road to wealth lies in the assets you control and the income they consistently produce. This principle sits at the heart of his philosophy. Kiyosaki is far from your typical financial advisor. Through best-selling books like Rich Dad, Poor Dad, he's earned renown for his straight talk, no-nonsense approach to money and investing. Rather than chasing ephemeral gains, he takes a long view, seeking out assets capable of spinning off continual income streams, decade after decade. This prominent idea cuts against the conventional wisdom, urging you to just save money or spend less. Kiyosaki charts a different course. In his philosophy, savers are ultimately losers. Rather than stashing away modest gains, he advocates channeling earnings into income-producing assets. This may seem counterintuitive, but it sets the stage for generating positive cash flow. As your assets begin throwing off consistent income, you circle those earnings back into acquiring additional assets. This self-fueling cycle becomes the engine propelling your wealth creation. With enough income-producing assets, you reach an inflection point where the cash they generate can fully sustain your lifestyle. Hello, financial freedom. Now let's get to the heart of it. Kiyosaki's 6 fundamental assets for building sustainable wealth. Each can turbocharge your net worth trajectory when used strategically. Asset number 1. Paper assets. This includes stocks, bonds, mutual funds, and exchange-traded funds or ETFs. Paper assets represent a share of ownership in a corporation, fund, or debt obligation that provides income streams. Many shy away from paper assets, viewing markets as akin to gambling, but Kiyosaki sees them as potent wealth accelerants if used prudently. The key lies in constructing a balanced portfolio centered on stocks and fundamentally sound companies, with excellent leadership and durable competitive advantages. High-quality, established companies with clear growth runways can deliver steadily rising dividends and share price appreciation over decades, generating continual income. Balancing these workhorse stocks with measured stakes in emerging growth companies can significantly amplify your returns. Master intelligent selection and allocation strategies, and paper assets become wealth accelerators, providing perpetual income streams that increase your financial freedom. Here are a few pointers on effectively utilizing this asset class. Seek out companies with clear competitive moats, visionary leadership, and identify growth vectors. Look for firms with rising revenues/earnings, reasonable debt levels, and enduring brands. Diversify across sectors, market caps, and geographies to smooth volatility. Rebalance portfolio allocation periodically. Allow time for compounding. Give stocks years or decades to appreciate substantially. Avoid reactive moves. Use dollar-cost averaging to build positions over time, easing the impact of market swings. Reinvest dividends and capital gains. Let compounding work its magic. Index funds and ETFs provide instant diversification. They simplify investing for beginners. Utilize tax-advantaged accounts like 401ks and IRAs to maximize returns. Asset number 2. Real estate. The time-tested titan. Real estate's dual advantages of cash flow and appreciation make it a perennial favorite. It's easy to grasp, which is why Kiyosaki hails it as the ultimate asset. Owning income-generating properties delivers steadily increasing passive income, especially when utilizing smart leverage strategies like mortgages or hard money loans. Additionally, appreciating property values mean your net worth climbs in lockstep over time. It's a win-win. Here are some tips for tactically tapping into real estate's wealth-building power. Consider both residential rentals and commercial properties based on your investment goals and risk tolerance. Commercial real estate often means higher returns. Thoroughly research promising neighborhoods and markets using metrics like infrastructure improvements, population growth, job creation, and overall housing demand. Identify emerging areas poised for growth. Crunch the numbers to confirm positive cash flow after expenses, taxes, and maintenance. Conservatively screen tenant applications. Seek value. Consider distressed properties or fixer-uppers with renovation potential and gentrifying areas. Sweat equity can equate to serious equity gains. Make interest rates and tax advantages work in your favor. For example, deduct mortgage interest and depreciation. Use leverage judiciously. Employ just enough debt to maximize returns, while retaining healthy cash reserves in case of vacancies. Consider REITs to gain diversified real estate exposure without the hands-on work of direct ownership. Moving on to asset number 3, commodities. This includes natural resources like oil, precious metals, agricultural products, livestock, and so on. Kiyosaki advocates allocating 5 to 10% of your portfolio to commodities for further diversification and as an inflation hedge. Commodities demonstrate low correlation to stocks and bonds. Their unique supply-demand dynamics help smooth overall portfolio volatility. In inflationary periods, they preserve purchasing power as prices rise. Here are some tips for tactically incorporating commodities. Gain exposure through stocks of commodity producers. Look for companies with low production costs, pricing power, and strong management. Consider ETFs that track a commodity price index. They provide a diversified basket of exposure in one vehicle. Focus on relatively stable commodities with steady demand drivers, like oil and gas. Avoid hyper-volatile commodities. Use futures contracts to agree now to buy or sell a fixed amount later at a preset price. Hedge using stop losses. Look at trends in historical commodity ratios. This can signal potential buying opportunities when pricing skews occur. Asset number 4, precious metals, specifically gold and silver. Kiyosaki views these as stable stores of value to hedge against inflation, market volatility, and geopolitical turmoil. Gold and silver has served as real money for centuries. Unlike fiat currencies, their supply can't be inflated on a whim. Their relative scarcity helps preserve purchasing power over decades. Kiyosaki suggests allocating 10 to 20% of portfolios to physical precious metals as financial insurance. Here are some tips for effectively incorporating precious metals. Consider buying gold or silver mining stocks rather than physical metals. This avoids storage costs while providing leverage as prices rise. For direct exposure, purchase minted coins or bars rather than jewelry to avoid excessive markups. Store in a secure safe or insured vault. Use dollar cost averaging. Build your precious metals allocation steadily rather than all at once. Understand the differences. Silver has more industrial uses driving demand, but it's more volatile. Gold offers pure monetary value. Take a long-term perspective. Metals may fluctuate, but appreciate substantially over long multi-decade periods. Study historical gold to silver ratios. This signals potential buying opportunities when the ratio swings too far in one direction. Asset number 5, oil. Often called black gold, oil investments can provide both income streams and capital appreciation. But oil is also more volatile than many other assets, making research and risk management essential. Kiyosaki notes that the world's most successful investors frequently have significant stakes in oil companies, reserves, infrastructure, and futures contracts. While requiring due diligence, this essential commodity offers long-term wealth potential. Here are some tips for strategic oil investing. Gain exposure by taking in equity stakes in best-in-class, low-cost oil producers with strong leadership and promising reserves. Master limited partnerships or MLPs offer exposure to oil pipelines and storage infrastructure while providing tax advantages and cash distributions. Consider service firms supporting drilling and extraction. Their fortunes rise and fall with oil prices, but avoid costly extraction expenses. Refiners can thrive whether oil prices boom or bust. Look for those with sustainable cost advantages and high utilization rates. Hedge against price drops using option strategies like covered calls or collars. Participate in gains while limiting downside risk. Index ETFs offer diversified exposure to the oil industry. Carefully vet ETFs to ensure optimal construction. Last but not least, asset number 6, cryptocurrency, the modern frontier. Cryptos like Bitcoin and Ethereum offer disruptive wealth potential, according to Kiyosaki. He suggests allocating 1 to 5% of portfolios to leading cryptocurrencies for enhanced diversification. Their increasing adoption and utility signal appreciation potential. Here are some tips for strategically investing in this 21st century asset class. Bitcoin remains the most established crypto with a considerable track record of long-term price appreciation. Its brand recognition makes it the standard. Ethereum's network effects, utility for smart contracts, and position as the second most adopted crypto give it staying power. Research other promising crypto assets, like Litecoin, solving specific problems like faster transaction times that may deliver exponential returns. Analyze tokenomics and circulating supply. Cryptos with solid underlying value drivers and limited circulation often gain value. Be selective. While thousands of cryptos exist, relatively few are likely to stand the test of time and be adopted sufficiently. Use dollar cost averaging. Given crypto's volatility, regularly allocating a fixed dollar amount helps smooth over your entry price. At this point, you may be wondering, how do I start my wealth building journey? Where should I focus first? The good news is that you can get started regardless of where you are today. Each person's path will be unique. If you're just beginning, consider paper assets like broad index funds as an easy entry point. They offer instant diversification, along with the wealth accumulating power of compounding over decades. Over time, continue expanding into other income-producing assets, like commodities, precious metals, and crypto, to further diversify your holdings. The key is converting income into wealth-building assets at every opportunity. And if you found value in this video, we invite you to join the MoneyWise investor family by clicking the subscribe button and ringing the notification bell now. Thanks for watching, and until next time, stay MoneyWise.